Welcome back to the channel, everyone. Today, we're diving deep into a specific stock that has popped up on our hard to borrow screener, looking at what makes it a potential short squeeze candidate and what you need to understand about the mechanics involved. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Today, our spotlight is on Global Interactive Technologies Inc., trading under the ticker GITS. Show GITS ticker on screen. GITS operates in the communications services sector, specifically within internet content and information. Through its subsidiary, the company runs Fanning, a digital fan engagement platform primarily in South Korea, designed to support online fan communities, content discovery, user interaction, and more. With a market capitalization of just $7.09 million, GITS is firmly in the micro-cap territory, making it a smaller, more volatile play. Why is cost to borrow and why it matters? So, what does it mean when a stock is hard to borrow? In simple terms, it means there's limited supply of shares available for short sellers to borrow. When you short a stock, you're borrowing shares, selling them, and hoping to buy them back later at a lower price to return to the lender, profiting from the difference. For the privilege of borrowing those shares, you pay a fee, known as the cost to borrow, or CTB. This fee is typically expressed as an annualized percentage. When a stock is hard to borrow, the demand to short it is high relative to the supply of shares available, which drives this fee through the roof. A high CTB indicates strong conviction from short sellers, but also presents a significant financial burden for them to maintain their positions. This is why you sometimes see annualized fees well over 100% because the daily cost to hold that short position becomes extremely expensive. Why this stock is hard to borrow right now? Now let's look at GITS specifically. Our screener flagged GITS with an astonishing annualized cost to borrow fee of 932.3%. Highlight CTB number that is an incredibly high fee, signaling extreme scarcity of shares available to short. The estimated float for GITS is only 2.4 million shares. Share float number, small float, means that even moderate buying pressure can have a significant impact on the share price because there are fewer shares available in the open market. While we don't have current data on shares available to borrow, that 932.3% CTB suggests the supply is severely constrained. Today, GITS sold volume of 411,300 shares, which is 4.9 times its 30-day average volume of 83,685 shares. Display volume stats. This increased volume, especially relative to its average, indicates heightened interest and activity in the stock. Our internal composite squeeze score for GITS currently sits at 42.5 out of 100. This score considers factors like CTB level, borrow supply, float, and momentum, giving us a holistic view of potential squeeze conditions. Squeeze mechanics explained. So, how does a short squeeze happen? It's a chain reaction. When a stock's price starts to rise, short sellers, who borrowed shares hoping the price would fall, start to face increasing losses. If the cost to borrow is also very high, their losses accelerate due to both price appreciation and daily fees. At some point, the pressure becomes too great, and short sellers are forced to cover their positions. Covering means they have to buy back the shares they initially sold to return them to the lender. Show graphic of short squeeze mechanism. This forced buying creates a surge in demand for the stock. If the float is small, like with GITS, this demand can quickly overwhelm the available supply, pushing the price even higher. This upward movement then triggers more short sellers to cover, creating a vicious cycle for shorts and a rapid ascent for the stock price. Dilution risk check. One critical factor to consider with any potential squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can depress the stock price per share. Even with a high cost to borrow, significant share dilution can offset or entirely negate any short squeeze potential by flooding the market with new supply, giving short sellers an easy exit and making it harder for buying pressure to move the price. For GITS, we've conducted a thorough check and found no recent dilutive SEC filings such as -1s, -3s, or 424 BS in the last 90 days. Highlight no dilution risk. This is a positive sign, as it means the company isn't currently adding shares to the market that could otherwise mute a squeeze. We also found no recent reverse splits for GITS in our look-back window, which can sometimes be a precursor to further dilution. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Despite the intriguing hard-to-borrow data for GITS, it's crucial to look at recent price action and maintain a balanced perspective. Today, GITS is down a significant 23.94%. Show today's price change over the last 5 days, the stock is up a modest 3.35%, but over the last 30 days, it's down 5.26%. Display 5 DAY and 30 DAY changes. While the high cost to borrow suggests significant pressure on shorts, a high CTB does not automatically guarantee a squeeze. It can also signify that short sellers have very strong conviction that the company's fundamentals will lead to further price decline, and they are willing to pay a premium to maintain that short position. What we'd be looking for in a potential squeeze scenario is sustained buying volume that drives the price upwards, putting pressure on those expensive short positions. Keep an eye on the volume. Today's relative volume of 4.9x the average is a good starting point for increased attention. So GITS presents an interesting case study with its exceptionally high cost to borrow fee and small float. It has the underlying mechanics for a potential short squeeze, but remember, the market is complex and many factors are at play. Always conduct your own thorough due diligence before considering any investment. If you found this analysis insightful, please give this video a like, subscribe to the channel for more deep dives into hard-to-borrow stocks, and let us know in the comments what stocks you'd like us to cover next. Thanks for watching, and we'll see you in the next one.